cover bad debt expense using the income statement approach.
I could still be the next Steve Jobs. You never know. That's why,
And if you're following in the book, we're going to do problem 7.1. And let's set up the problem. They tell us we have a beginning balance in accounts receivable of $574,000. We have a $54,000 credit balance in our allowance account. And they tell us we had credit sales of $2,700,000. And we had sales returns of $80,000. So we've got net sales of $2,620,000. Hopefully you can understand why, if we're using the income statement approach, we use net sales, not gross sales. Because if they return the goods, then they don't owe us the money and we don't have to worry about them paying us. So we use net credit sales to calculate the bad debt expense. The problem goes on to say that we collect $2,483,000. Okay, so you can see the balance in our accounts receivables constantly changing for these transactions. Then it says that we write off accounts of $68,000, and so we write off their account. I want you to notice two things: that this entry, this writing off of an account, has no effect on net income. These are both balance sheet accounts. In fact, it has no effect on total assets or total current assets or net realizable value of accounts receivable, for that matter. So if you look, we had $657,000 net realizable value before we wrote off these accounts, and $657,000 after. Because when we write off accounts receivable, the debit goes to the allowance account. It's accounts receivable and it's contra account. So there's no pain and suffering when we write off an account using accrual accounting. It's also time to take a moment and look at these entries. These top four entries would be the same whether we were using the income statement approach or the balance sheet approach. The only thing different between these two approaches is the following entry: how we calculate bad debt expense. In fact, the form of the entry would be the same under either approach, but the amount of the entry would be different. In this problem, it says we're going to take 3% of net credit sales and call that bad debt expense. So we're going to estimate bad debt expense. And notice it's 3% of net credit sales. We didn't even need to know what was in the allowance account. We could have worked this problem without even knowing what was in our allowance account. Of course, we want to know just because we're curious, but we calculate bad debt expense as a percentage of net credit sales, and of course the debit goes to bad debt expense and the credit goes to our allowance account. Okay. So this is the only entry that's different between the two methods. Now, let's say that up here when we wrote off somebody's account, and we all agree that journal entry where we write off an account, that journal entry has no effect on net income, no effect on total current assets. But what if somebody pays us after we've written them off? So let's say somebody owed us $7,500. We get a check in the mail for $7,500 from one of these accounts we've written off. Well, what I'm going to do then is I'm going to undo that journal entry. So in that journal entry, I credited accounts receivable. I'll put their account back on the books and I will just reverse that entry. So if we get a check in the mail for $7,500 from one of our customers, first thing I'm going to do is I'm going to put them back on the books. Then I'm going to record the cash and write off their account. And as you can see, the debit and credit to accounts receivable offset each other. Whoop, that shouldn't be there. The debit and credit to accounts receivable offset each other. This combined entry, and in fact, the only thing that really matters is this part, because the debit to accounts receivable and credit to accounts receivable offset each other. But I debit cash and I credit the allowance account. When I collect money from somebody I've written off, I end up crediting the allowance account because they really don't have an account until we put it back on the books. Okay. Then notice that this entry has no effect on net income because these are all balance sheet accounts. I hope that helps you, and I hope you have a great day. So thank you, and I'll talk to you tomorrow.